Welcome to the Deep Dive, where we take complex financial research
Yeah.
and give you that strategic shortcut to being instantly well-informed. Today, we're tackling a really critical, high-stakes moment in every Canadian's retirement journey. I'm talking about the mandatory conversion of your registered retirement savings plan, your RRSP, into a sustainable income stream.
And for many of you listening, that deadline is probably coming up fast.
It is, and the choices you make around that conversion, when and how much you pull out, it can literally mean a difference of tens, maybe even hundreds of thousands of dollars over your retirement.
It's a huge
A
puzzle.
puzzle with some very profound implications.
And that financial puzzle is exactly what we're here to solve today. Our mission really is threefold. First, we need to understand the structure of what's often called the RRIF trap. Second, break down a complex but essential idea, the marginal effective tax rate, or METR.
The MTR, right, that's the key.
It is. And third, we'll lay out the two main strategic paths. Think certainty versus control that let you maximize your wealth and, crucially, avoid those punishing clawbacks.
And this isn't just theory, is it? It's important to say where this analysis comes from.
Oh, not at all. This is rooted in some very detailed research from top Canadian actuarial bodies and, highly specialized firms that live and breathe this stuff. We're talking about the practical work done by companies like Muneris Financial Services, who operate right at that intersection of complex tax law and retirement income planning.
Okay, so let's start at the beginning then. Before we get to that hard conversion deadline, we need to understand the role the RRSP plays. Canada's retirement system, it's built on 4 pillars, right?
It is. And where your private savings fit in? Well, it's the critical foundation for your security. You've
Yeah.
got Pillar 1, which is the safety net OAS and GIS. That's the minimum floor.
And pillar 2.
Pillar 2 is your CPP or QPP. It's mandatory insurance based on your work history.
But those first 2 pillars, they're critical, but they often don't replace enough income to really maintain your pre-retirement lifestyle.
Exactly. That's where Pillars 3 and 4 come in. Private voluntary savings. So Pillar 3A is your workplace pension, your RPP. But 3B and 4, that's your personal money, RRSPs, TFSAs, non-registered investments.
And here's the staggering part of this whole conversation, the reality that underpins everything.
It's that the government programs just aren't enough. And those company pensions, the RPPs, are a luxury that very few workers actually have.
How few? Give me the number again.
The 2023 data shows that a staggering 62.3% of paid workers did not have an employer-sponsored RPP.
Wait, 62.3%.
That's nearly 2/3 of the entire working population. Their retirement security rests almost entirely on their own personal financial decisions.
So you're saying almost 2/3 of working Canadians are betting their retirement entirely on their own savings. That just changes the whole weight of this discussion.
It's the main event. In fact, these private savings now contribute the single largest share of retirement income for Canadians over 65.
The largest share.
It accounted for 46% of all annual income in 2023. This capital isn't just personal wealth anymore. It's a massive economic engine.
46%. Wow. That supports something like $150 billion in Canadian GDP. And as you mentioned, it saves the federal government about $16.5 billion a year by reducing reliance on those low-income benefits.
It's fiscally responsible to save. But
Hmm.
this engine of private wealth, it comes with a ticking clock.
And that hard deadline is when you turn 71. By the end of that year, the RSP is gone. It must be converted.
And you have 2 main options. You can take the money and buy an annuity, a guaranteed payout contract, or you can convert it into a registered retirement income fund, the RRIF.
And most people pick the RRIF because they want to keep control of their investment.
They do. But this is where the trouble starts. That control comes tethered to the RRIF trap.
Okay, so explain that mechanism. What makes RRIF withdrawals so punitive later in life?
The problem is the mandatory minimum withdrawal schedule. It's dictated by the Income Tax Act.
The government wants its tax money eventually.
Exactly. They want to make sure those tax-deferred savings are eventually taxed, so they force you to pull the money out, and that percentage, it just climbs relentlessly year after year, no matter what the market is doing or what you actually need.
You're forced to liquidate. How steep is that curve? Because if you saved well, those minimums could be enormous by your late 80s.
Oh, they're very aggressive. It starts small, but it ramps up fast. By the time you hit age 80, you're forced to pull out almost 6% of the remaining balance.
And at 90,
By 90, it jumps to nearly 12%, and then from age 94 on, the minimum is fixed at a massive 20%.
20%. So one-fifth of your remaining portfolio is liquidated and turned into taxable income every year after you turn 94.
And that mandatory forced taxable income is the tripwire that triggers the worst financial outcome, the benefit clawbacks.
Right. And to really get the danger here, we have to look past the normal tax brackets and talk about that term you mentioned earlier.
The marginal effective tax rate, the METR.
Okay, let's unpack this for everyone listening. The METR is the real cost of earning your next dollar. It's the income tax you pay, plus the value of any government benefits you lose because you earned that dollar.
It's the whole picture. And this is where the RRIF minimums just wreak havoc. Let's start with the high income hit. The OAS clawback.
The OAS recovery tax.
Yes. Once your net income pushed higher by those mandatory RRIF withdrawals crosses a certain threshold, it's around $90,000 right now, you start losing 15 cents of your OAS benefit for every single dollar you earn over that line.
So if you're already in, say, a 40% tax bracket and then you add a 15% OAS clawback, boom, your METR has just jumped to 55%. That's on money you were forced to withdraw.
It is. But the research shows the real catastrophe is often on the other end of the scale. The low-income side.
The Guaranteed Income Supplement, or GIS, trap.
And the clawback rules for GIS can be far, far more aggressive than for OAS.
You're talking about effective tax rates that can actually go past 100%. That seems impossible. How does earning money make you financially worse off?
It happens when multiple clawbacks stack up on top of your income tax. The source data has a really stark example for a low-income retiree who depends on GIS. Imagine they have a small RRIF, and they take an extra $1,000 withdrawal 1 year.
Okay, $1,000 of extra income.
First, they still pay income tax on it. Let's say that's $300. Now, because that income is reported, the GIS calculation for the next year is triggered.
And the GIS clawback is, what, 50 cents on the dollar?
At least. It's often 50 cents for every dollar of private income, but it can stack with provincial benefits. So let's use the researcher's number. A $750 loss in future GIS payments.
Okay, so you have $300 in tax, $750 in lost GIS.
And maybe another $50 in lost provincial tax credits. So that person earned $1,000, but they lost $300 in tax plus $800 in total benefits.
So their total loss is $1,100. They earned $1,000, but were penalized $1,100.
They have a net loss of $100. That's an effective tax rate of 110%. It's a brutal disincentive to save.
It's a nightmare. And it proves that the common wisdom, just defer your tax forever, can be strategically catastrophically wrong.
Exactly. But once you know this minefield exists, you can choose one of two strategic paths to navigate it.
All right, let's talk about path one, the annuity. This is the certainty machine. What's the fundamental trade-off here?
The annuity provides guaranteed income for life, full stop. You give a lump sum to an insurance company, and they take on all the risk.
The risk you'll live too long, and the risk the market tanks.
All of it. It's a complete outsourcing of worry.
But the drawback is liquidity. That money is generally gone. You can't just access a lump sum if you have an emergency.
That's the core trade-off. You give up control and access. And yes, if you pass away early, the remaining funds subsidize the pool for those who live longer.
But because that risk is pooled,
the annuity can often provide significantly more guaranteed lifetime income than you could safely draw on your own from a portfolio. You're trading access for rock-solid certainty.
Okay, that clarifies the security path. Now for path two, RRIF optimization. You keep the control, but you have to actively plan to manage that tax exposure.
Right. And the first, most obvious strategy for couples over 65 is pension income splitting.
This is the first line of defense.
It is. The higher income spouse can attribute up to 50% of their RRIF withdrawals to the lower income spouse for tax purposes. It just dramatically flattens your combined tax profile.
Right, you're flattening the curve. Less volatility in your income means less chance of hitting those cliffs. Okay, what's next? Something that's often confused, asset location.
Yes. This is so fundamental. It's not what you own, it's where you own it. You have to place your assets in the account where their tax treatment is most beneficial. So high-income stuff like interest from GICs or bonds, income that's taxed at 100% of your marginal rate.
That belongs inside your registered accounts like your RRIF or TFSA where it's sheltered.
Exactly. And the opposite is true for things that get preferential tax treatment like Canadian dividends or capital gains. Those are often best held outside in a non-registered portfolio.
Because they're already taxed at a lower rate anyway, so they don't need the full shelter?
Precisely. You don't waste that valuable registered room on them.
Now we get to the real intellectual core of this deep dive, the counterintuitive move. The RRIF to TFSA acceleration. This goes against everything we're taught, which is to defer tax as long as possible.
It does. But the research suggests paying tax early can be the superior strategy. It's all about strategic bracket harvesting. You look at your early retirement years, say between 60 and 70, before CPP and OAS have kicked in, when your income might be temporarily lower.
And during that window.
You purposefully withdraw more than the minimum from your RRIF.
So you're taking a calculated tax hit today. You're paying tax on that money at a known lower rate, maybe 20 or 25%.
Exactly. You pay the tax, and then you immediately take the after-tax cash and contribute it to your TSA, assuming you have the room. You're essentially prepaying the tax on money that was guaranteed to be taxed later at a much higher rate.
And why is the TSSA the ultimate sanctuary that justifies this early pain?
It's the clawback protection. Yes, tax-free growth is great, but the critical advantage here is that every dollar you withdraw from a TFSA is invisible to the government.
It's not reported as income.
It's not, so it's clawback proof. It does not affect your GIS, your OAS, or any other income-tested benefit.
So the trade is pay a known 20% tax in your 60s to ensure that same capital avoids a guaranteed 45% tax rate plus stacked clawbacks when those crushing RRIF minimums hit you at age 90.
That is the strategy in a nutshell. You are managing your lifetime tax rate, not just your annual one. If you wait, the government forces the issue when you are at your most vulnerable.
Fascinating. Okay, one last tactic, investment allocation within the RRIF. If a retiree has already established a secure floor, maybe through a pension or an annuity, how aggressive should the remaining RRIF capital be?
If that base security is guaranteed, the primary threat that's left is long-term inflation over a 25 or 30-year retirement. The annuity is essentially doing the job of your bond portfolio.
Providing stability.
And guaranteed income, which means the rest of your capital needs to focus on growth to fight that inflation. Much more. The modeling suggests allocating as high as 95% to equities. It sounds terrifying in retirement, but the logic is sound when the base risk has been eliminated. The annuity is your bond.
That makes perfect sense. Okay, let's zoom out. The complexity here really highlights the value of professional advice and also the need for some policy reforms.
It absolutely does. The research is compelling. Advised Canadian investors accumulate, on average, 2.3 to 3.9 times more assets over 15 years.
That's a huge difference.
It is, and it's because of better saving rates, smarter allocation, and just disciplined behavior. Navigating these METR traps really requires sophisticated, personalized modeling.
And because the system is so complex, experts are advocating for changes. The source material lists 3 major policy reforms. First, extending that age 71 deadline.
Yes, raise the mandatory RRSP conversion age from 71 to 73. That gives you 2 more critical years of tax-deferred compounding. It can make a huge difference.
The second reform is for lower and middle-income seniors.
Right. For people with modest RRIF balances, the proposal is under $200,000, eliminate mandatory withdrawals entirely. This would directly help about 75% of all account holders.
And it would effectively eliminate that GIS trap for the people who need that benefit the most.
It de-risks their entire retirement. And the last one targets the cost of saving itself, eliminating the GST/HST on investment fund management fees.
That's seen as a regressive tax, isn't it?
It is. Middle-income Canadians using mutual funds and ETFs shoulder that burden. Removing it would be a meaningful boost to their long-term compounding.
So to summarize this whole deep dive, you're faced with a choice. It's the rock-solid security of an annuity versus the control, and let's be honest, complex optimization required for a RIF.
And the constant in both paths is the need for proactive strategic planning to avoid those punishing METR clawbacks.
And remember that core counterintuitive insight.
That the conventional wisdom of deferring tax and drawing down your RRIF last, it often leads to you paying the absolute highest tax rate later in life, right when those mandatory minimums kick in. Delaying payment can mean paying more overall.
With that in mind, here is a final provocative thought for you to carry forward into your own planning. What specific income-tested benefit are you most vulnerable to losing? Is it OAS, GIS, a provincial benefit? And based on that risk, are you willing to pay a guaranteed lower tax today through that RIF acceleration tactic in exchange for the permanent, clawback-proof, tax-free benefit of a maxed-out TFSA later in life? That calculated trade-off that is the essence of modern retirement strategy.
And if the thought of modeling those complex scenarios, figuring out the optimal annuity trade-off or executing that RRIF to TFSA acceleration, if that feels overwhelming, know that specialized support is out there. The firms that do this kind of research, like Muneris Financial Services, they focus specifically on creating these customized investment management and tax strategy solutions.
So for those who need help translating these complex models into a personal plan and who are looking for that specialized expertise on annuities, RIFs, and TFSAs, the team at Muneris Financial Services, led by Mansoor Khalili, serves clients across Canada. You can find them at their website, muneris.com-shu, that's muneris.kango.com, or reach them directly at 778-898-3202. This is the exact type of expertise you need when navigating that crucial age 71 deadline.